Be Wealthy and Smart, episode 534.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about 8 financial mistakes to avoid for retirement. And this comes to us from an article on CNBC.com written by Mark Henricks. We have 3 bullet points. The first one says, a big part of generating enough income to live off of in retirement is identifying and mitigating risks to that income stream. The second bullet point says, bear markets, interest rates, and inflation can all wreak havoc on retirement income. And the third bullet point says, physical and mental wellness, along with personal disposition and behavior patterns, also impact retirees' financial decisions. And the article says, generating enough income in retirement calls for managing risks to that flow of cash. Retirement savers can't do that unless they know what those risks are. Financial planners identify these 8 prime retirement income risks and provide guidance for reducing them. Number 1, timing. The risk you'll retire during a bear market. Dallas-based certified financial planner Scott Stratton offers this scenario. The market plummets 30% the year you retire and start withdrawing 4% annually from what was previously a $1 million portfolio. In 12 months, your portfolio falls to $660,000 and 4% is no longer a sustainable withdrawal rate, said Stratton, president of Good Life Wealth Management. One remedy, suggested by Fort Worth, Texas CFP Tim Estes, is to have a robust cash emergency fund to tide you over without tapping retirement accounts. If your expenses are $60,000 a year and you have $60,000 in a money market, who cares if the market goes down, says Estes, founder and CEO of Estes Financial, because it does come back. Okay, I want to pause there and say I agree with having at least a year's cash on hand. I think that's great, but we have seen times when the market has had more than a 1-year bear market. In fact, from the peak of 2000 to the bottom in 2002, we had a rough 2-year bear market. So 1 year's income may not be enough, and having to tap into money while your account is really down, that could be a problem. So I think in addition to having the cash on hand, I would have some short-term fixed income instruments like short-term bonds that could also be used because they could come due in a year or 2 years. And at the end of that 2-year bear market, you have the cash to either reinvest into the market or to continue to use to live on. So I agree with the cash strategy. I also agree with adding some short-term fixed income instrument in your portfolio for additional flexibility. Point number 2, inflation. The chances that inflation will erode your purchasing power. This is a huge risk as retirement is becoming longer, Stratton said. If inflation is just 3%, your cost of living is going to double every 24 years, and some costs like healthcare are growing at much more than 3%. Estes recommends equities as an inflation counter. You have to have some of your money in the stock market so you can get returns above inflation, he said. With inflation running about 3.5% a year, a moderate portfolio returning 6 to 7% keeps up with inflation even after withdrawals, he says. All right, the second point is that inflation erodes your purchasing power and you must do something to grow your money more than inflation. And I completely agree with that. Right now, we're lucky to have very low inflation, but cycles change and that's not always going to be the case. So we really have to keep an eye on inflation and outpacing inflation and what we can do to hedge against inflation. A TIP is a Treasury inflation protected security, which is a Treasury security that is indexed to inflation in order to protect investors from the negative effects of inflation. The principal of a TIPS increases with inflation and decreases with deflation as measured by the Consumer Price Index, the CPI. And when a TIPS matures, you're paid the adjusted principal or original principal, whichever is greater. I also agree that you need to have some stocks in your portfolio to continue to counter inflation. Not only that, but you just need the growthiness of being able to invest in something that can outperform and continue to compound at a high rate and build wealth for you. If you have all of your money in cash or bonds, you might not outperform inflation, and you're not getting any growth out of that. You're basically just treading water. So having part of your portfolio in stocks while you're in retirement, I see as a really important thing to do. Mistake number 3 is longevity, the chance you'll outlive your money. Worries about outliving retirement savings are partly due to longer life expectancy, says financial planner Charisse McKenzie, president of Saturn Wealth in Gilbert, Arizona. Today we have a 1 in 4 chance of one person in a couple living to age 95, she said. To mitigate this risk, McKenzie suggests delaying claiming Social Security benefits until the maximum benefit is reached at age 70. The longer you expect to live, the longer you should delay Social Security, she said. And I completely agree with that. The longer you can put off taking Social Security, the more you will lock in the higher rate of income for yourself. Outliving your money is something that polls say is the number one fear of people in retirement, is living longer than they have money for. And although there are some safety nets out there like Medicaid, it really is for people who have no assets left and are involved in skilled nursing care, which is the higher level of care. It doesn't take care of you if you need custodial care, which is just things like helping you eat and bathe and change your clothes and things like that. So living too long is definitely a mistake we want to avoid, but the best way to do that is just invest better, continue to increase your knowledge about investing, watch your compounding rates, watch the cycles that you're investing in, and all of the things that we talk about on the podcast about how you can make your money work harder for you. So using those money engines effectively, whether that is investing in stocks, whether that's real estate, whether that's a business or something else, those money engines and getting your money to work hard for you become more important the older that you get. Mistake number 4. Interest rates, the risk you won't be able to get adequate returns on safer debt instruments. Although rates are rising, current fixed income returns lag well behind historical norms. This provides a potent challenge to people seeking retirement income. Estes suggests high dividend stocks as alternatives to puny bond yields. I've got investments that I think are relatively safe, paying anywhere between 5% and 7%, he said. Well, I agree with that. A lot of investors are using dividend-paying stocks to help supplement the income portion of their portfolio because bond yields are so low. The only thing is, you do have principal at risk if you are invested in a stock, even if it's a stock that pays a nice dividend. Companies that pay a nice dividend tend to be larger companies that have cash flow that they can pay out on a regular basis, and they oftentimes can even increase the dividend each year. Once in a while, you run across a company that's been out there forever, like General Electric, that runs into some major problems. But fortunately, it's relatively rare that a company that is so large would have massive problems like that and possibly be considering bankruptcy. Having said that, you really need to think outside the box because even the large companies that are paying dividends, for example, because they're a large oil company, 10 years, 20 years down the road might see a big change in how we use oil. And it might be that we have a lot more electric cars at that time. So you need to kind of keep one eye on the future and future trends and think about how might things be changing and what companies will be really classic even as technology changes in the future. Something to think about. Mistake number 5. Investor behavior. The risk you'll dump stocks in a temporary downdraft. Left to their own devices, individual investors tend to sell low during bear markets. That is one reason Mackenzie suggests relying on a presumably more dispassionate professional money manager. People are too emotional about their own money, she said. It's wise to have someone handle it for them. Well, I agree. It's very difficult to control your own emotions. And unless you're a very experienced investor who can sell high and buy low and move contrary to the current market sentiment and not go with the herd, it is good to have a professional work with you, give you sound advice, and be non-emotionally attached to your money. Mistake number 6, withdrawal rate, the risk of taking out too much too soon. 4% has long been the considered safe withdrawal amount retirees can pull from their accounts annually without risking running out of money. Today's outlook for lower returns on all sorts of investments has many experts questioning that rule. Currently, the safe percentage can vary depending on whether a retiree expects other income from pension or annuities, Mackenzie says. Financial planning software uses simulations to produce more reliable figures in complex situations. We put all their assets and income expectation in there and show them with their existing strategy how long their money will last, she said. Yes, I agree. It's a good idea to look at your withdrawal rate, run what's called a Monte Carlo calculation to see if you can continue to take this income without running out of money. There was a study done that said if you take 4% out of your account, it likely will last over your lifetime. But it's not necessarily a guarantee, and it's something that you have to continue to watch. So doing special calculations to see what that number is for you, I think is a good idea. Mistake number 7, cognitive decline, the risk of becoming unable to manage your finances. Even a modest level of age-related cognitive impairment can make managing an investment portfolio challenging, to say the least. Mackenzie says diffusing this risk typically involves preparing a healthcare power of attorney in advance. Before you get there, have somebody who can take over your account and can make decisions for you if you can't yourself, she said. Well, I agree with that. It's good to have a plan in place for someone who can take over making decisions for you should you have some cognitive impairment. That's a tough thing. It's tough to have someone step in and tell an elder that they can no longer drive, but at some point that has to happen. And the same thing happens with your finances. If at some point they're not able to manage it themselves, then it's great to have a plan in place to have a child or an attorney or some other trusted person be the one to look after them. Mistake number 8, healthcare costs, the chances of major medical bills. To avoid having medical bills drain a retirement account, delay retiring until age 65 when Medicare eligibility kicks in, Stratton says. Even when you have Medicare, you could have substantial out-of-pocket health expense, he added. Long-term care is a potentially high-impact risk, he says. To reduce it, he suggests getting long-term care insurance, preferably in your 50s when premiums are lower. Other retirement risks may also crop up. SD sees future tax rates as a potential threat to savers with well-stocked individual retirement accounts and other tax-deferred accounts. Right now, taxes are at the lowest rates we've had in decades, he said. To avoid the risk of higher taxes in the future, Estes has many clients converting to Roth IRAs. End of article. Yes, healthcare costs are definitely the wild card when it comes to planning for retirement because we never know what kind of healthcare you're going to need. How major is it? Is it custodial care where they're just taking care of activities of daily living? Or is it care where you really need help doing everything? It's often said that the end-of-life expenses can be 30 to 50% of your total estate. So just that last month can be incredibly expensive. And if you have a surviving spouse, that can be a disaster for your spouse. So getting some long-term care insurance can be a good idea to help defray some of those costs. But it is expensive too. So you have to weigh the benefits. And they make the point that taxes are the lowest we've had in decades. And that's very true. Who knows what taxes are going to be in the future? And that's something that's very difficult to plan for. The best thing to do is to continue to have money engines working for you so that your money continues to grow. That's really the best offensive plan that becomes your defense. So becoming really good with investing, whether that's in the stock market or in real estate, your business, or something else, is really important during your lifetime while you're younger. And that's why I recommend getting the most financial education that you can so that it pays off during your entire life. It's not something that you can really just delegate to a financial advisor necessarily. It's something that you really need to understand and be on the same page and be able to make the right decisions for yourself and for a long lifespan. So once again, I'll review what these 8 costly financial mistakes to avoid for retirement are. Number 1 was timing, the risk you'll retire during a bear market. Number 2, inflation, the chances that inflation will erode your purchasing power. Number 3, longevity, the chance you'll outlive your money. Number 4, interest rates, the risk you won't be able to get adequate returns on safer debt investments. Number 5, investor behavior, the risk you'll dump stocks in a temporary downdraft. Number 6, withdrawal rate, the risk of taking out too much too soon. Number 7, cognitive decline, the risk of becoming unable to manage your finances. And number 8, healthcare costs, the chances of major medical bills. I'll leave a link to this article in the show notes and on my website so you can take a look. If you're wanting to accomplish some of the things that we talked about in this article, I recommend getting my book, You're Already a Wealth Heiress, Now Think and Act Like One, 6 Practical Steps to Make It a Reality Now. This is a book that works for men too, because after all, financial information is non-gender specific. Men have told me that they enjoy the book and not to be put off by the title. So I agree with that. I think it is something that men and women get a lot out of. And I really break it down and make it easy for you to see how to get to $1 million or more in retirement. So check it out on Amazon or Amazon.uk or your local bookstore. If we haven't connected yet on Instagram, go on over to Instagram.com/Linda P. Jones and get my daily wealth tips. And don't forget, we still have our review contest going in March. You have a really good chance of winning up to 25 prizes. I'm giving away 11 Wealthy Mindset audio sets valued at $197, 11 Wealth Heiress books personalized by me, and 3 wealth mentoring sessions with me valued at $500. All you need to do is leave a podcast review and your name will be entered into the drawing 5 times. A book review on Amazon will get your name entered into the drawing 7 times, and if you do both, your name is entered into the drawing 10 times. This goes through the end of March, and I'll name the winners on the next podcast after that. And don't forget, we have a survey with 10 quick questions to fill out. Let me know what you like about the podcast and what suggestions you have. That way I can tailor-make more episodes just for you. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.